All right, futures indicate we're going to get close to another record high on stocks this morning. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are off today. Bloomberg Open Interest starts right now.
Coming up, retail sales unexpectedly rose in August, providing one of the final slices of data before the Fed decides on rates tomorrow. And exactly what the Fed will do remains front and center of market minds. We'll discuss with Morgan Stanley's Brian Weinstein, JPMorgan's Gabriela Santos, Evercore ISI's Ed Hyman, and Julia Coronado of Macropolicy perspectives. And on the corporate front, Microsoft launches a $60 billion buyback as Intel scores a major deal with Amazon. Let's take a look at where the markets are trading right now. In terms of the futures, we continue to see gains here. S&P futures up about 25 points. We were at 56.33 yesterday, and the record high for a closing high is 56.67, so near as damn it to it. NASDAQ futures up about 0.7%, and you do see the 10-year yield right now rising just about 1 basis point. In terms of the stocks to watch, Danny Berger is going to take you through some of the big corporate moves. Danny?
Got to kick it off with Intel, up nearly 4% this morning, landing a big customer. That is Amazon's AWS, but it's also postponing its planned factory in Germany. Microsoft, that is up 1.6%, a $60 billion share buyback, one of the biggest in history, a continuation of what they had before, and they're going to rise their dividend by 10%, rounding things out with Hewlett-Packard, up 3.8%. This is some sell-side activity. Bank of America upgrading it to buy from neutral, citing the Juniper deal and cost cuts. Matt.
All right, we have breaking news from the Justice Department. The DOJ is ramping up scrutiny of banks that collectively lost billions of dollars in the collapse of Bill Hwang's investment firm. Prosecutors are reviving an antitrust probe into whether banks colluded in discussing how to unwind their Archegos bets. We'll have much more on this story later in this hour, although I think it's fair to say that those banks that tried the hardest to avoid losses lost the most money. So it seems like they've already had quite a bit of punishment there. In terms of retail sales, we had this sort of final slice of data coming out before the Fed decision tomorrow, and we had an advance in retail sales. So U.S. retailers posting a surprise gain in August. Let's break it down with Michael McKee, Bloomberg's chief international economics and policy correspondent. He joins us from Washington. Mike, what do we see?
Well, we're not seeing anything that's going to convince one side or the other in the 25-50 debate, but it does suggest that the U.S. economy is certainly hanging in there and doesn't seem to have a lot of problems. There are some issues under the hood, however. You take a look at overall retail sales, and they were up 0.1%. The forecast was for them to drop. And the control group, 0.3 after 0.4 last month, so still a very strong retail sales component there. And you can see on the top line there that that's GDP now from the Atlanta Fed, 2.5%. Some people think that's going to go up to 3% after today's numbers, so not an issue with the overall economy. But there are some things, as I said, under the hood that are a little concerning, and one is that the composition of sales is a little worse this time. We have seen some areas that people thought would be strong be a little bit weaker, including food stores and grocery stores, department stores and clothing stores, which during this month usually do well. I want to show you this chart here and just take a look at two colors. The forest green that you can see on top of these and the deep blue. Those are internet sales in the forest green and auto sales in the deep blue. And you can see they have really pushed around retail sales. This is the ECAN chart on our Bloomberg, and you should get one if you don't have it already. But it shows those have been the issues that have really moved markets around, or moved retail sales around over the last year. What does this all mean? How you started asking me. Doesn't seem to mean much to markets, because when you look at what the markets are pricing in at this point, there's been very little change in overnight index swaps or in the Fed funds futures market. This is swaps. And as you can see, since retail sales came out, there's not much of a change. People still think that there's a chance of 50 and there's a chance of 25.
All right, Mike, thanks very much. Michael McKee there in Washington walking us through retail sales with the ECAN function on your Bloomberg terminal. We are joined now by Morgan Stanley Investment Management Head of Global Markets, Brian Weinstein. Brian, you're best known for your work in fixed income. So you really, I think, have a unique perspective among people who watch sort of cross-asset management. The bond market expects a 50 basis point rate cut. Do you as well?
You know, I've been in the 25 camp all year. Even when we were pricing in 7, pricing in 0, they're going to go 50. I mean, I think the theme was right. They should have gone in July, right? The best news is the debate will be over really shortly because it doesn't really matter. But I think when you look at the Fed, the path from July to now, we didn't get a lot of data that's clear, right? Jobs were weaker, inflation mixed, but obviously trending towards 2. Retail sales better, bond market doesn't care. The Fed has an opening. Well, listen, we know 2 things. 5.5% is not neutral. The second thing, let's not forget, 5.5% was not nearly as restrictive as we thought. The economy is not cratering. So the Fed needs to go from 5.5 to neutral. We don't know where that is. Start with 50, get the ball rolling. Could it be a hawkish 50? Is that possible? Could they pull that off? Give the message that we're not starting a huge easing cycle here, but let's get towards neutral and let's do it now because we want a soft landing. Those are really hard to find.
Could a hawkish 25 do something about? I know we're literally splitting hairs, but you know this scenario where they go 25 and they do dots, they do a summary of economic projections that suggests that bigger cuts are to come.
Well, yes, your second point is perfect, right? The Fed needs to give us something to look at. They said look at the data, and the data says do 25, or by the way, maybe don't, right? But don't do 50. So the data thing wasn't really right. So what is their forecast? Where are we going, and where do they think neutral is? Listen, the bond market says it's 2.8. I think that's way too low. If 5.5% didn't kill the economy, what if it's 4? Right? I mean, if you had told me 3 years ago we'd be at 5.5 now, and we had stayed there for a year, we all would have laughed. It was impossible. So we don't know where they're going. They need to give us more. I think the important thing here is they don't fall behind the curve. Again, soft landings are hard to find. We know there are parts of the economy that are struggling, right, inside the consumer sector. You can see it on the ECAN, right, if you look at where the strength is in retail sales. So ease and give us some guidance. But so far, I think what they've done is let the market dictate where they're going and leave us confused. The equity market seems to see it. The equity market says we're going to be okay. Usually as a bond guy, I think the bond market's right. I think the bond market's pricing in way too high of a chance of recession. I think the stock market has it correct.
Does that hurt to say?
It does, a little bit. It's hard for me. But the stock market was right on 10-year notes at 1%. Right? They said, no way. There's more growth. There's more inflation. Stock market was right. So it's been on a roll.
Well, wait, just to be clear, something that's like cutting 200 basis points in the span of a year for you, is that just normalization or does it indicate something worse?
I think it's unlikely that that's the path. I think that's the market's probability weighted outcome of where we end up. I think the Fed is saying with 50, and I hope they say this, more now in the hopes that we don't have to do a lot. I could see them doing 125 before January. And can we speak about rate hikes next year? Right? Not today. But if it's a soft landing and if inflation does bottom and if we do help out that other piece of the economy, get through the election, get some spending from the government, could the economy continue to be okay? Well, then we'd have a totally different story. I think the market's priced wrong for 200 in a year, but we could get 200 by March if needed.
I'm just so confused about why we need these rate cuts, and I'll ask you, and I'll ask Gabriela, and I'll ask Ed, and I'll ask Julia, right? Because what's growth right now? Like 2.5%, 3%, you know, and earnings were fantastic. Stocks, you know, risk assets are at all-time highs, and I can only imagine the outcome of a 50 basis point cut to be higher prices for housing, right? And affordability is one of the biggest problems this nation faces. So I feel like they can only exacerbate those issues that are driving, you know, the electorate crazy.
Yeah, I have a lot of sympathy for that view. I think from a market standpoint, just from it's not really theoretical, from a functional standpoint, if 5.5 is restrictive, and I think we'd all agree, to some degree it is, and inflation has gone
where do you see that? Where do you see the restrictive
listen, I think you see it
nature
at mortgage rates at 8% were pretty difficult for people to deal with. Now at 6 and change, we don't see a ton more activity, so to your point, maybe that's not the problem. Affordability could be, but you see it in certainly in weaker consumers, you see it in subprime auto, right? You definitely see it. It's not affecting the economy writ large, But if you had 9% inflation for the a year ago, and you've gotten government subsidy, and those subsidies are running out, I think people are feeling the pinch. So I agree with you. My message would be we're doing this 50 because we're calibrating. That would be my word. We're calibrating. It's not a big easing cycle. The economy doesn't need it. It's a bit more of a textbook response of getting real rates to a normal level. Look at financial conditions indices. I can't think of a cycle in my career where the Fed was easing with financial conditions this easy. So the risk to me that the market is missing, it's not in break-evens, it's really not in the yield curve, and it's not in fixed income, which is why I think it's incorrect. There's no inflation risk, there's no risk to fiscal, there's a yield curve that's way too flat for this part of the cycle, and if neutral's 3.5, the 10-year note should be 5, not 3.6.
All right, Brian, you're going to stick with us. We're going to talk more with Brian Weinstein, Morgan Stanley. Quick check on what's going on in terms of futures. And as we've been pointing out, the retail surprise didn't really move the market much. You still have futures up on the S&P 500 about 0.5% right now. NASDAQ 100 futures up higher, 0.75%. And the 10-year yield actually not moving at all. Right now stuck at 362. And I believe it's that way if you look really across the U.S. curve. Coming up, Trump hopes to regain momentum after the gunman incident at Mar-a-Lago with 48 days until the election. We'll talk politics next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. The U.S. Justice Department is ramping up scrutiny of banks that collectively lost billions of dollars in the collapse of Bill Wang's investment firm Archegos. It was only months ago that Wang was convicted for deceiving those firms. Now prosecutors are examining how those firms, Wang's lenders, unwound more than $150 billion in bets placed by his family office. This, according to people familiar with the matter. UniCredit is set to ask the ECB for regulatory permission to build as big as a 30% stake in Commerzbank. That, according to a person familiar with that matter. CEO of UniCredit, Andrea Orchel, is still in pursuit of a potential takeover of the bank, and Europe is longing for its first big cross-border takeover. And talks between the PGA Tour and the Saudi-backed Live Golf Tournament have dragged on for over a year since their shock deal, their announcement of a merger, thanks to one little detail: player pay. John Rahm's reported $300 million Live contract struck late last year is a particular sticking point. Some PGA players want Rahm and others to hand back money that they'd made from Live, but that's terribly unlikely to happen.
Matt, would you give your money back if you're in this?
Absolutely not.
Yeah, I was going to say mine would be gone. There'd be no more money to speak of. It'd be in some houses and something. Elsewhere, Matt, let's move on to D.C. Donald Trump is pinning the second assassination attempt on him on Kamala Harris and Joe Biden's rhetoric this election season. It's an effort to sway momentum in his direction after weeks of majority attention on the Democratic changes to the ticket. Let's bring in Bloomberg's Michael Shepard in Washington. Mike, is it going to be successful this time? This is a similar tact they took on the first attempt on the former president's life. Is it going to make a difference this time?
Well, it's a great question, Danny, because we're entering now the home stretch of the campaign. We have 7 weeks roughly to go, and early voting is beginning in some states very soon. So there is no time to dawdle or to waste opportunity. So Donald Trump is looking to make the most of this now. He is attempting to pin some responsibility on Kamala Harris and President Joe Biden for inciting somehow the two men, the gunman in Pennsylvania from July and the man who was apprehended on Sunday, for somehow being responsible for those the actions of those two people. But he offered no evidence. And the FBI, even as it's been investigated, has seen no connection whatsoever between the rhetoric from the vice president and the president in terms of stoking what has happened. So it's unclear whether that will hold with voters as a whole. It does play well with Trump's base, though.
Are you concerned, Mike, about the Fed taking some flack for the cut tomorrow? Especially if it's 50 basis points, do you expect the Trump camp to then come out and say, it's unfair that the Fed is just doing it to boost the Biden-Harris economy?
Well, for months, Republicans have been seeding the ground for exactly that scenario and saying that look for what they would call a politically motivated rate cut right before the election to somehow help juice the economy and make those numbers look better for the Democratic candidate heading into November 5th. Now, we also know, though, from political research and from years of studying elections that voters' impressions of the economy really take hold more in August than September, so that by the time anyone might feel the actual effects of a rate cut, except for maybe an immediate trading on the exchanges on Wall Street, people have made up their minds about how they feel about the economy and what it feels like at home. So it may not have that kind of effect, even though Republicans may be suggesting there could be a political motivation here.
Michael, appreciate it. Bloomberg's Michael Shepard there. Just want to bring us quickly some breaking news, more eco data. Tier 2 data, call it what you want. U.S. August industrial production data higher than expected. It rises 0.8% month over month. 0.2 was the expectation. That accompanies retail sales data that was also stronger than expected. Not too much of a change in the bond market. Front-end yields up some 3.5%. Okay, we're still here with Morgan Stanley investment head of global markets, Brian Weinstein. Brian, I want to ask about what Matt was kind of alluding to, this idea of a cut being political. You have Elizabeth Warren and company writing a letter to the Fed, and we can talk about the fact that maybe she does this quite frequently before Fed meetings, but saying that they shouldn't go 20, not 50, but 75. Does it represent something dangerous of trying to influence the Fed, or just noise?
I think it's noise, right? I think it's fine. I mean, the senators have the right to write letters to the Fed, and they're public, and we can read them, and the Fed can react or not. But in this case, I think
presidents can do it.
Presidents can do it. Yes, and that's more problematic, maybe. Maybe they shouldn't. But listen, I think if the Fed were not priced to do anything, it would look very political. But 75 seems a lot. But it's in the right theme, and it's going to happen-ish, and it's a little bit of noise, I think, around what the political situation is very noisy, I think, for Wall Street. I think what's interesting is, I think what the market's saying is we're looking through it. Don't give us a blue wave or a red wave. Please let it be a little chaotic, right? Let there be an offset, a balance, whichever way it goes. And if you can give me that, we can actually figure out we're not going to get outlandish policy on either side, and the markets will be okay. It'll be interesting if that changes, but for now, I think it's noise.
I got to get your take on equity markets now that you're running global markets. What do you think about this stock market? Others? Are we off to the races now that, central banks around the world are in cutting cycles?
I'm surprised we're back at the highs. I thought we'd be range bound a bit more. But again, if the market is looking through to elections and then our Santa Claus rally, which always comes, I don't think we're going to melt up. I think we've done that. But a break to the upside here, especially if yields stay this low, leaves us with not too many alternatives. Yeah, I could see us continuing to grind and really frustrating people. It's interesting that leadership keeps changing. I think if the Fed is easing and we get some more stimulus from China, which has been a big drag, and Japan decides to slow down a bit because it's gotten a little noisy and they like, I think, a bit of inflation, I do think you could see some strength back in commodities and energy, which has gotten hit, which has weighed on the indices and kept some of the bigger ones down. But yeah, I like the U.S. market. Again, we've seen some strength out of Europe despite their lagging economically, and the ECB on a bit of an easing cycle. I don't expect that to change just yet, but if we can get the dollar to be really fundamentally weak, we might be able to see some leadership move overseas at some point. It might be a next year story.
I'm worried you're already talking about the Santa Claus rally
in
September.
I know, it's coming.
It
comes.
You talk about the change in leadership. Utilities have been on this amazing tear, on track for their best year since 2014. The Bank of America global survey just came out saying that investors are most overweighted since 2008. What is this thing? Is it safety? Is it AI? Is it everything to everybody, and it's only up from here?
I think it's a weird combination of safety and yield, right? So listen, a lot of people miss their chance at a 5% 10-year note, and so we get some income. It's, if I'm wrong, it's cyclical. It's defensive, and I'll get some safety. I am surprised that we had the rally. They stabilized, tried to come down, and then found new highs, despite the fact that then big tech comes back and leads again, and utilities don't go down. I think it's a commentary on yields, and again, not to bring up an old, Tina, but I'm not loving fixed income here and wanting income. I think people are reaching. It can't go on forever, but certainly it was out of vogue for so long. It's had a heck of a comeback.
So a lot of people were worried that we were out over our skis in terms of earnings. Obviously, this quarter was great, right? But looking forward, maybe we wouldn't continue to see that kind of strength, or in 2025. What's your view on earnings?
I think with the Fed easing and again going 50 and getting ahead of the curve again, you get a little bit of a drop in earnings because we get the lag effect. It doesn't work right away. But with conditions this easy, I think you look into end of first quarter, second quarter of next year, and you can have a big boost in earnings again. The funny thing about inflation dynamics is we went for so long where companies could not raise prices because there had been no inflation for a long time. Once you've seen 8 or 9, and it goes back to 2, I think companies have some more pricing power than they did. Again, not like they did last year into COVID with the government response. But I think the psyche of the way consumers respond to price changes is they're a bit more okay with it, which makes inflation sticky and helps earnings. And so I think as long as the Fed eases and employment stays reasonable, we can be bullish into the beginning of next year. If interest rates start to move like I think they will, that will put pressure eventually on the stock market, but obviously not today's story.
Brian, really wonderful to catch up with you today. Too. That is Morgan Stanley Investment Management Head of Global Markets, Brian Weinstein. Okay, coming up, Instagram unveiling a sweeping overhaul today for teenage users. We're going to have the details next in your social climbers. This is Bloomberg.
Just moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are gaining, and we could have another record high on the S&P 500. Right now you can see S&P futures up 0.4%, adding about 23 points. NASDAQ futures up 0.2%. The Russell 2000 up about 0.9%. You hear the opening bell on the New York Stock Exchange. Oh, everyone's taking pictures. And then on the NASDAQ marketplace as well. This could be a pretty cool day, right? Because we closed out at like 56.30, a little bit more than that yesterday on the S&P 500. We only have to climb less than 40 points to make a record today, and it looks like that should be pretty easy. These are the actual cash prices. It's going to take a few seconds for things to settle in, but we're already at 56.53 and 56.67 is the record close. 56.69 is the record intraday. So we could definitely be there, especially if the equity market continues to buy the bond market's message that the Fed is going to cut 50 basis points, and that's usually what stocks like to see. Then tomorrow, of course, we're going to get buy the rumor, sell the news action. In terms of the individual stocks that are moving, we're still keeping an eye on Intel. Remember, yesterday the stock rallied because it's going to get military contracts that are going to open up $3.5 billion of government largesse. Well, it's found another customer in Amazon, apparently. They're going to make a chip together, a fabric chip, which apparently works for AI, and that's a great thing to say for investors, right? And as a result, the stock is up another 3.5%. So a gain for a stock that has been a true loser this year. Intel, like the pioneer in chip making, has fallen 60%, and the stock is worth a total of less than $90 billion. So very interesting stuff there. Danny, what are you watching today?
Well, I'm watching Microsoft, and sure, Intel got a vote of confidence from AWS. Microsoft is giving itself a vote of confidence. They raised their quarterly dividend by 10%. They also announced a $60 billion share buyback. Now, that does match the size of a repurchase they had done 3 years ago, but this is still a monster buyback in the scheme of things. Those shares up nearly 2% just out of the gate on the opening bell. I'm also looking at HPE this morning, Matt. This is from some sell-side action from Bank of America. They have upgraded it from neutral to buy, up 5.33% for HPE. The analysts there, they're confident in their deal to buy Juniper. There had been some head scratching around how they would fund this and if it would be an issue, but Bank of America says that this is a cyclical recovery coming from them across networking, services, and storage. Matt.
Well, cross-networking services and storage.
What more do you want?
HPE, my eyes kind of glaze over. I feel like they need a rebranding because that's just not exciting. Let's discuss the Fed. That is exciting. And markets with Gabriela Santos, JPMorgan Asset Management, Global Market Strategist. Gabriela, Danny Berger cannot stop the debate. 25 or 50. It's
much
all she talks about. I'm sure it's all everyone talks about around you. What do you think? What are they going to do?
Yeah, so I think the direction of travel, very clear. Rates are coming down as the Fed normalizes rates. But very much for tomorrow, there's so many unanswered questions around the magnitude, 25, 50, the frequency, monthly or quarterly, and the end point, right? What's the normal interest rate for the economy these days? I do think now that bond markets seem to be pricing in about a 60% probability for 50 tomorrow. 2-year yields have come down for 5 months in a row. They might be disappointed tomorrow, not because I think that they shouldn't do 50, but I don't think that they will. Just given how gradual this Fed has been, just because Chair Powell tends to favor no dissents, plenty of consensus. But if we zoom further out, once we get a little bit more comfortable with these questions around magnitude, frequency, and endpoint, it's still an environment that the why rate cuts are happening are still positive for risk assets, right? They're coming because it's a normalization of rates and in conjunction with a soft landing.
A normalization of everything, really. I mean, it seems like the labor market, right? 4.2% unemployment. That's not bad. 3.4% was what was abnormal. And if you believe Bill Dudley that we're getting to this tipping point and things are going to get worse, I just don't see how, right? Mickey Bowman was talking about last year how, immigration really swelled. Can I say that as an active verb? The labor pool, right? It grew because of so many foreign-born workers. That has stopped now, that, flow of immigration, and it doesn't seem like there's any reason. Earnings were great. Why would the labor market be such a problem?
Yeah, I think very much what we've been seeing across a whole different number of job market indicators. We need to look at a whole bunch to put together a picture here. It's still very much just normalization. Normalization of the demand side in terms of the pace of hiring, and normalization in terms of the labor force participation rate. But I think for the Fed, they're still a bit uncertain about how long this immigration surge will last and this increase on the supply side. Number two, some more mechanical questions about some changes in surveys, how they're calculated, response rates. So for them, I think if they're in the business of managing risk, which they are, they're willing to be a bit more proactive to make sure that we do continue just seeing normalization and not a worse weakening in the labor market. Hence why they're being more forceful about saying the time has come for rate cuts, for a normalization of policy.
I was going to say, managing of risk sounds like a different shade than data dependent.
Yeah, they're not data driven at this point, are they?
Right,
are
if
they
they're
still
managing
data dependent?
I think they are looking at the data and realizing that in terms of managing risk, it has become much less about inflation, much more about the labor side, and a focus on labor market indicators from here on out. And you can actually use large language models to comb through different speeches by Fed members, the statement, and what you start to see is they're mentioning the labor market about 30% of the time, and inflation only 20%. So it's very clear. They still say the balance of risk is balanced, but I think by their speeches, they're actually saying that the balance of risk is actually on the labor market side. And that's really the justification for cutting tomorrow, for normalizing policy. I think that's how Chair Powell will phrase it at the press conference.
I mean, you see a very clear view, but it is a market that's torn. To your point, we oscillate somewhere above 50 for deciding whether this will be 20 or 25 or 50. We look at retail sales data as like the data point that matters. We're reading the tea leaves from the FT and journal stories. Is this a problem that that's where we're at? Just days away and now 1 day away from a Fed decision?
I think that is the reason why interest rate volatility has stayed still quite elevated versus pre-pandemic norms. So it's off the very highs that we touched middle of last year, but it's still quite elevated because we need more information, which I think we'll get with the release of the updated summary of economic projections, especially the dot plot, around exactly what's the pace of rate cuts here. So I do hope we have a little bit more clarity. In terms of retail sales, I don't think it changed the game, really. It came pretty much in line with consensus for the control measure. It still suggests an economy that's doing quite well, just normalizing a bit the pace of growth, but no concern here in terms of the overall pace of consumption.
All right, so normalizing rates with the normalized pace of growth. What about portfolio construction? Do we normalize positioning? I mean, do we normalize balance?
Yeah, I think there are several action calls here around normalizing portfolios. For example, We've all talked a lot about how there's $6 trillion plus of money sitting in money markets and cash-like instruments. I think that's been the approach recently on the fixed income side of portfolios. So it's time to normalize your actual amount of liquidity versus your core fixed income allocation, which is really there for income, for diversification in terms of recession. And really, I think after tomorrow, when it's absolutely obvious there's reinvestment risk, we do expect to see a lot of money flowing into especially short to intermediate duration fixed income. We'd rather have moved before. You're not at the best price you could have gotten, but it's still pretty decent income there. And then in terms of normalizing on the equity side, right? Portfolios have gotten very lopsided into the US versus elsewhere, into Mag 7, mega cap tech versus other sectors. And you finally started to see that broadening happen. Early days, we think there's a lot more to come here. So important to balance there between sectors and styles and regions.
What is the elsewhere from the US that money should flow to?
And here is where I don't think we're... I think as human beings, we tend to focus sometimes on the negative news that we hear, especially as investors from international, because they've disappointed for 10, 15 years. But there's actually been very strong performance for the last year and a half, almost 2 years here. We're very, very, very constructive on Japan, Japanese equities.
Early August was rough.
Early August was rough, but the glass half full way of looking at it is that multiples have contracted 17%, right? There's another bite of the apple. It's not really the macro, although that's getting less bad from a nominal perspective. It's all about corporate governance reforms. So much more about domestic, about the value style in Japan. We're having so many conversations with our institutional clients about it. And then it's EM, especially outside of China. Big play on AI with Taiwan doing very well, but could Korea be a more discounted option? And then we're also looking to India, very, very expensive if there are any pullbacks, any rationalization of valuations there. So there's a lot of good stuff.
Well, Gabby, let me just say, I'm so looking forward to tomorrow when the 25 versus 50 debate is put to an end, so we can actually move on to
I
these
hope
sorts of
so.
debates.
Yeah, then we can focus on Japan. And I mean, we should do a show from there. We should go with Gabby to Japan.
I was going to say one exists, but we could take it out. We can commandeer it.
Oh, right.
I'm not
That's
against
true.
it.
We already have one.
Yeah, we do have a Japan
Yes.
show.
We can all join the Japan show.
Exactly. Gabby, looking forward to seeing you in Japan. Gabriela Santos of JPMorgan Asset Management, thanks so much. Okay, coming up, Virgin Galactic landing a $5 price target for Morgan Stanley. We're going to have the details in your top calls next. This is Open Interest.
This is Bloomberg Open Interest. Quick check on what's going on in the stock market right now. We do have gains, and we're getting back closer to all-time highs at 5650 on the S&P. The Nasdaq gaining a little more, 0.4%, and the small caps on the Russell 2000 up more than 0.75%. The market preparing itself for, I think it's fair to say, what it now believes is going to be a 50 basis point cut tomorrow by the Fed.
Yeah, it's been pricing that in, more than 50% odds that we would get that, but it's like Fed roulette, choose red or black and hope you get it right. Okay, time now for Wall Street Beat. Back when Donald Trump's empire was facing troubles and nobody else would lend to it, one man would. His name is Gregory Garibrandt, and he's the head of Axos Financial, and he's one of Wall Street's best paid CEOs. Here with more on it is Bloomberg Business Week's Max Abelson. Max, this is such a good story, full of character and color. So who is this man?
Thank you so much. Well, I just want to say that one of the good things about being a journalist, like a reporter, is that, we go through life being like, who is anybody? Other people, whether or not they're powerful, are like a total mystery to us, I think. And one thing that was really fun about writing about Gregory Garibrandt, who is the CEO of a relatively small bank called Axos, although actually I should say it has gotten much bigger over time, is that I went into it knowing very, very little about this guy. And by looking at a couple of things like lawsuits, and also by doing a lot of interviews, I ended up with what I hope is like a pretty colorful and I hope a really accurate portrait of a guy who, he is willing to do what it takes to win in his way. And that means, I don't want to give away my fun story, but it means getting into lawsuits with, short sellers, and Axos has had a lot of short sellers, or at least a group of very intense ones, whistleblowers, his kid's school, believe it or not, his neighbor. He's a guy, he says he's not litigious, but what I would say is that there are some Wall Street types, some finance types, including Greg Garabrandt, that when they fight, you know, they are not messing around.
Yeah, scorched earth was a term I read in the story. Also, I think he might debate whistleblower, right, as the correct term. I would indeed. I think it's a great story, and what I love about your stories is I always read them till the last paragraph. So, also a very fascinating man that you chose to report about. The company, to me, was, I thought, really interesting. Before he took over, it was a very small financial institution, and it was a weird name like Bank of the Internet or something.
Bank of the Internet.
Right?
Exactly.
And now, even though they've had their issues with Hindenburg and they've had their issues in recent months with stock depreciation, it has soared over the time that he's been in charge.
Soared. I mean, let me give an argument for this guy. He took over a bank that was making, I want to say, like $3 million a year. Pennies, you know, pennies. I think it had like $1 billion of assets, which, you know, if the three of us worked really hard, we could start a bank with $1 billion of assets. That's very tiny. Actually, I'm not sure we could. No offense to the three of us.
Very confident.
With the two of you, I'm sure we could do it.
But let me just say that he came in with a vision, and he wanted to, you know, when you say Bank of the Internet, or I say Bank of the Internet, it had no branches, and it used that as like a cost-effective measure to grow. But he also did something really interesting, which is that he was willing to lend to customers sometimes that other banks were not willing to get into business with. Now, he, of course, says, look, I often turn away customers that other banks would be willing to do business with. But we looked in this story at customers like Alex Jones's media company, Binance US, and then, of course, there's Donald Trump. And, you know, while it may not literally be true that no one was willing to lend to Donald Trump, Trump's empire was under a squeeze there for a second, because Deutsche Bank, other banks he had gotten money from after the January 6 riots, they were like, we're not going to do business with these people any longer. Greg Garabrandt and Axios, essentially one way of thinking about it is that they helped prop up Trump's empire at a really crucial moment. And what he would say is, look, I did it because the math worked. It's a good loan. The case against Greg Garabrandt, the case against Axios, is like the metrics are too good to be true. All of that incredible rise can't be believed. And then very importantly, they are too far into commercial real estate at too scary a time. So we're going to have to see what happens. I'm honestly, after spending all this time studying the bank and reporting on the bank, I'm not even sure myself.
I mean, after all that time, because you go into this and there's some high-profile instances with him, whether banking with Trump, be it the lawsuits, be it the short sellers. Over the time you spent on this story, how did your view of him change?
You know, I have to say, it really did change. And in some ways, I think I have him to thank for that. Like, sometimes in journalism, you get in touch with someone. Let's say I'm trying to write about Matt, which I'm really glad I don't have to write about Matt.
Me too.
It would be a great story.
That would not be good.
You know, you end up, first you start with other people. You know, I would speak with the people who work with him and know him best, and then you start to get a picture, and then you know you come to him with questions. And sometimes Matt says, "Buzz off, Max. I don't want to talk to you. I don't like your tone." And credit to Greg Garabrandt, whatever anyone might think of him or what anyone might think of bank CEOs, he was willing to take our questions really, really seriously. And what he said is, "I pray every night for the wisdom to make the right decisions." And you know, he may have politics that sound you know, intense or out of place, at least in New York City. He rallied, as I think someone mentioned, you know, against like a Marxist curriculum at his kid's school. But from where he's coming from, the perspective that I got is that like he is a guy who wants to run his bank well. He's a guy who wants to win on his terms. He's a guy who, like, I got the sense that he sort of like despises mediocrity. You know, he does not want to be mediocre. He does not want to work with mediocre people. He doesn't want a mediocre bank. And, you know, as a finance reporter, I can't say whether that's like good or bad. All I can say is like, I found that really interesting.
He's a champion of free market capitalism, which when I was a kid, that was okay in America. You know, Max, great story. Really appreciated you joining us, reading it and you joining us. Max Abelson there. Get your story on the Bloomberg with NI Big Take Go. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are off today. Coming up, retail sales unexpectedly rose in August, providing one of the final slices of data before the Fed decides tomorrow. And what the Fed will do remains on the center of markets' minds. Top economists Ed Hyman and Julia Cordano weigh in. Plus, we're going to get a view from the C-suite. We'll talk about inflationary pressures and on-the-ground economy with the CEO of Snap-on. Meanwhile, Matt, has the market reacted at all to retail sales data?
Yeah, no, it didn't react. We were up in futures before the retail sales data. We were up after the retail sales data, about the same, and now we're up in the cash trade, just about 1/3%. It's been that way all morning. Right now we're at 5650 on the S&P 500, so we're less than 20 points away from an all-time record high on stocks. I think it's so fascinating. We're at an all-time high in risk assets. We have growth at almost 3%. Unemployment's down at 4%. And meanwhile, we're asking the Fed to cut rates by 50 basis points. Why? Let's get some insight from, he's been called the greatest living market economist. Ed Hyman joins us, Evercore ISI founder and chairman for over 40 years. Ed has been institutional investors' top-ranked economist, and he has a new call on the economy. I think you're in my camp, Ed, which is like the economy's buzzing along pretty well. You used to be looking for a recession, and last week you said you had to make the tough decision to flip it. Why?
Because the economy's buzzing along. And one of the things I pride myself on is being practical. I'm a bottom-up. I listen to people. I look where I am, and I walked over here. It's buzzing along. And the system's awash with liquidity. The market's already at a new high. The Dow hit a new high yesterday, so let's not. And then I've been pushing my recession forecast out.
Yeah.
And my friends have been laughing at me. They say, Ed, you'll be right eventually. We'll have a recession someday. So I had the fourth quarter down, and it's not going to be down.
So just be clear, you said you kept pushing it out. Is it just gone? Soft landing, here we come. No recession in view.
That's correct.
Okay, so no recession in view. Then Ed, tell us about this 25-50 cut debate. Where do you land on it if a recession's not on its way?
If they don't do 50 tomorrow, I'll be shocked. I've been at this a long time. And the Fed they have a system where they use people at the Journal or the Financial Times to communicate with us, with you, Matt, about what they're going to do.
I wish they would use me for that, Can you get them to call me?
You're too expensive.
That's the problem. Yes.
So you have...
And so they've said, pretty clearly they're going to do it. But at this point, the way I cut things, whether they do 25 or 50, if they do 25, they'll lather it on pretty quick that they're going to do more later.
Yeah, so you have now a pretty optimistic call on the economy. Why does the Fed need to be, I guess Gabriela Santos said they're going to calibrate with this 50 basis point cut, but did they really need to be a heck of a lot lower? Does 5.5% seem super restrictive to you?
Well, this gets into my old self. Yes, inflation is probably down to 2. I'm exaggerating, but let's say it's down a lot. And the yield curve's been inverted for the longest time ever by a lot, almost a year. And money growth is about 2%, which is pretty skinny.
Yeah.
And all this stuff leads by a year or two. So if they want to make a difference, they need to look ahead. And so I think they've sort of taken a few pages out of my playbook, free of charge, and so they're making a preemptive move here. I don't know if there's any politics involved. Do you think?
Do you think? I mean, we have Elizabeth Warner coming out saying you should go 75 basis points. Is there going to be a political element to this decision?
What do you think? I mean, what they do now, what they do now couldn't really change the economic landscape. But if the market was going to go down, this could change that.
The economic landscape is something that Evercore ISI is famous for, putting into notes that we can read and understand. I mean, you have company surveys that are famous for both the breadth of the surveys and the methodology that you use to poll these companies. What are they telling you right now?
Economy slowed a lot, so you can understand this. 0 to 100, 0 to 100, 50 as expected. The surveys 2 years ago were 60. And this past week, there were 48. So it's slowed a lot. 45 is when you get into recession territory. So we're not there yet, but we're sort of close. And this is one of the things that worries me. Professionally, I was on one side, I flipped to the other. I don't want to flip back.
But you did reserve, I read your Friday note, you did reserve the right to flip back.
Oh, no, I'm happy. Listen, yeah. I don't mind flipping. I just want to be right. And so I'm happy to flip back and forth if I need to.
With all your market experience, and Ed, you're a historian of this market as well as just a participant in it. I mean, is there a time like this where you have to be so agile? It's not you alone, Ed. It's so many people have to keep calibrating with every piece of data that comes in. We keep going back and forth. How out of the textbooks are we right now?
Well, Danny, you've made a difference. I mean, there's so much financial news compared to 50 years ago. 30 years ago, I thought to myself, I should start a news station that focuses on business news. I have charts that I would write on them, but now it's gone way past that. So the news it's changed so there's so much information out there which makes people need to change. Like we're sitting here talking about the Fed tomorrow, 50 or 25, like it makes a huge difference. And it probably doesn't make a huge difference, but you guys make it sound like it makes a huge difference.
Well, this was actually one of the questions that I have prepared for you. I mean, if we do get a 50 basis point cut especially, is there a risk that the Fed reignites inflation? I've heard a lot of people say, we could see housing prices start to take off again, and they're already out of reach for a whole generation of kids. Is there a worry? Do you have any worry that inflation comes back?
No. I've been very bullish on inflation coming down, and that's worked out well and has preserved what's left of my career.
Your integrity. No, you've been right on that for sure.
And so, and like you said it, we're not quite getting there, but the price of houses is so high, it's hard for them to go higher. The price of eggs is everything. So I go to a place in the summer that has a place you buy sandwiches in the store, and they charge me now $14 for a roast beef sandwich. Oof. And when I go down there to get sandwiches for the family, I have to take out a home equity loan. It's just hard to go to 15. And probably 2 years ago it was maybe 6. But anyway, I think inflation is going to keep coming down. As hard as that is to believe, because it's come down so much, but that if the Fed is thinking about cutting 50, that's one of the reasons, is because inflation really is coming down, and car prices are up, enough that you have to raise your eyebrows.
Enough to hurt my feelings, for sure.
Sandwiches and cars, all you two care about.
Which takes a lot to hurt your feelings.
If I could just backtrack and do a defense of Matt and Mai's job and the media that's out there, it's not just us that exist, Ed. It is a world awash in data. There is so much data out there, not just government data, but private data. Everybody trying to pick through every tiny thing to try to understand it. Is there an element when you look through the daily analysis of 2550 that we're kind of missing the forest for the trees, that we're too concentrated on data point dependence?
I don't mind being data point dependent. I mean, that's what I do for a living. And I think I'm probably as good as anybody. And I do the government data. I think I spent 2 hours yesterday preparing for the retail sales report.
Wow.
What a life.
So was it a letdown this morning then?
Well, it's always a letdown, but it was a little better than expected. And nominal retail sales, just what you pay for a sandwich or a car, was up 2%. Real retail sales were up probably 3%. Because we've had so much deflation in goods prices, real is up more than nominal is, which is a whole nother, you could spend a couple of years on knowing which is more important, real or nominal. But anyway, so people spend a lot of time on the data, but also the quality of the interpretation. I'm not trying to be overly nice to you guys, but the quality is really good.
Well,
we'll
I appreciate it. I'll take it
we'll
for sure.
And I will also take the name of where you get your sandwiches from after the show. We won't do it on air. I don't want them to get more expensive.
Ask Matt, he knows.
I know that shop.
Okay, good. You guys will fill me in after. Ed, you are never a disappointment. It is so wonderful to catch up with you morning. Always
Danny.
wonderful. That is Ed Hyman, Evercore ISI founder and chairman. Okay, let's get a look at stocks moving this hour. With that is Abigail Doolittle. Abby?
Well, we do, of course, have the S&P 500 up about 0.5%. Helping out to the upside, Intel and Amazon. Intel has won Amazon's AWS unit as a customer to build a custom chip. They're going to co-invest on this custom chip, calling it a fabric chip having to do with AI. In addition, Intel yesterday, of course, did receive the award to receive up to $3.5 billion for chip making for the U.S. military. If we take a look at Hewlett-Packard, we're going to see gains here as well. Right now, up very healthy 5.6%. B of A has upgraded shares to a buy on seeing lots of positive catalysts ahead. Valuation is one of them. The ability to cut costs is another. And then they also believe that there's going to be an overall recovery, a cyclical move higher for the networking space, and that should be a rising tailwind or rising tide, I should say, for Hewlett-Packard. And then finally, another big tech name that's higher, Microsoft. They have issued a new $60 billion buyback. They've also raised their dividend by 10%. Shares were responding quite well, up about 2%. What's interesting to me here, though, is the stock is still well below its all-time high by about 6%. And on the year, it's up a healthy 17%. But, Matt, compared to some of those other big tech names out there, such as NVIDIA, it's not as robust as one would think, this range.
I was looking at this stock in the aftermarket yesterday after this story crossed the terminal, and I couldn't believe it was only up, 2%. You don't often see $60 billion share buyback announcements, do you?
You don't see it often. We did see it from them, of course, a couple years ago. The stock is responding well, but not quite as much as you might think. And again, in terms of on the year, it's up less than 20%. This range that stocks have been caught in for the last couple of months, it seems as though it's taking a little bit of a toll, so to speak.
Yeah. Abby, thanks so much. Abigail Doolittle talking to us about Microsoft. Coming up, Julia Coronado joins us, Macropolicy Perspectives founder, weighing in on what the Fed should do next. This is Bloomberg. Now to high interest to look at what's making headlines around the world. Canadian Prime Minister Justin Trudeau suffering a big political setback after his Liberal Party lost a special election in a Montreal district that until recently was considered a safe seat for them. The loss is Trudeau's second significant defeat at the ballot box in just a few months and raises pressure on him to step aside before the next election. U.S. bank merger deals are set to face steeper regulatory hurdles under new FDIC rules. The guidelines are part of the Biden administration's push to clamp down on consolidation by financial firms. The FDIC will meet today to vote on these new rules, and we'll bring you the details as they come across the wire, Danny.
Meanwhile, all the attention turns to tomorrow. Will it be 25? Will it be 50? It is Fed roulette. Let's catch up now with Julia Coronado, Macropolicy Perspectives president and founder. She's with us now. Her firm is expecting the Fed to cut by 50 basis points. That is a change, Julia, from you and the team's call. You did have 25. Julia, great to talk to you today. Look, you're not the only one that's changed in the past couple of months. You've had some really big thinkers do the same, even as the economic data hasn't exactly gotten weaker. So why the pivot from 25 to 50? What's changed your thinking?
Well, we changed our thinking on what the Fed should do after the July employment report that we got in early August. And that was solidified by the August employment report, which is to say that the labor market is cooling off. And it is not a story of supply, it is a story of demand. Demand for workers is cooling off, and it's not stabilizing. It's an ongoing cooling trend. It's going to be the leading indicator of consumer spending. Policy is in a restrictive place. So that's the key here. This is an unusual cycle. The Fed is cutting just to bring interest rates into a more neutral setting. It's not cutting interest rates to stimulate the economy, which is fine. It's recalibrating policy in order to balance the risks and keep this good economy on track and get to that stabilization in the labor market, which doesn't look like it's happening yet. Right now, we're seeing the unemployment rate drift consistently higher.
How do you measure that, or how do you come to that conclusion that policy is restrictive? Because risk assets are at an all-time high, right? Growth is pretty normal at 2.5% to 3%. Unemployment at 4.2% seems about as normal as could be, right? It's still less than the average. And that, Jerome Powell tells us, is due to more of the supply side than anything else. So where does it look restrictive to you?
So it looks restrictive in all the key areas you'd expect it to be restrictive. Investment is pretty lackluster. The housing market is basically stopped. It's completely unhealthy, not moving at all. And interest-sensitive spending on the consumer's part, like autos, very price-sensitive, very lackluster. Rising consumer delinquencies are an indication that the median consumer and the lower-end consumer, they've exhausted that excess savings. They're feeling the pinch of higher interest rates. And in general, just that caution that we hear from earnings reports. We do a detailed scraping of earnings reports on their hiring and firing intentions. And yes, layoff intentions remain low, but hiring intentions are drifting consistently lower. Companies across sectors are just reporting a greater reluctance to take the risk of adding new employees. They're being very strategic, very, very cautious, managing their workforce through attrition. This is not a bullish indicator. This is an indicator that underpinning and at the core of every cycle is that positive feedback loop between hiring and consumer spending. And it looks like it's not as robust as it was certainly a year ago and not even 6 months ago. So again, it's not like the Fed needs to have their hair on fire and panic. But nobody thinks 5.5% is a neutral interest rate. And every interest rate, if you look at bank lending, for example, the credit impulse in the US economy in real terms is negative right now. So, all the leading indicators say the direction of travel is continued slowing. If you're good with growth right here, then you need to recalibrate policy.
It's the slowing, not slow, though, Julia, that has allowed for a divide, not just among market participants, but on the Fed. I mean, realistically, someone like Mickey Bowman, Barkin, Musalim, who have been quite hawkish, are they likely to come on side to a 50 basis point cut, or could this be the first Fed decision, I believe since 2005, where you get a dissent?
Yeah, we could easily see a dissent, and Governor Bowman is a decent candidate for that. I think that a lot of people on the FOMC, you're absolutely right in the framing there, that there is a mixed set of views on the committee, and more people, everybody's on board with 25 probably, or almost everybody, but not everybody's going to be on board with 50. I think most people on the committee can be convinced. I don't think we would be getting the media reports we're getting if Chair Powell didn't feel like he had a solid base of support on the committee. And there's a lot of people that are sort of in the middle. Actually, you cite President Musalim. He's an interesting example because he came out of the gate pretty hawkish when he took the role. But his most recent remarks have been a lot more flexible. I don't know that he's convinced about 50, but he's not a voter right now either. So it wouldn't show up as a dissent. If I look at the voters amongst the regional Fed presidents, is President Barkin or Bostic or Daley likely to dissent? I don't think so. I think they can be convinced that, because I think they're going to frame this as a catch-up. It's not going to, their hair is not on fire. It's not going to be an ongoing sequence of 50s. It's a 50, catch up, followed by an expected sequence of 25 basis points.
Julia, quick final question. Obviously, affordability of housing has been a problem for a generation of kids who are now adults and can't afford to get into that market. Chris Whalen wrote to me last night, said home prices will scream when Fed cuts. Big political problem for the central bank. You disagree?
I do disagree. I think this is an unusual housing cycle. The fact that housing prices haven't adjusted with higher rates is a reflection that we essentially have no transactions. We don't have any price discovery because everybody's just hunkered down with their 3% mortgage rate. If mortgage rates move from the sevens into the fives, that's still higher rates than where most people are. You're not going to get some kind of housing boom, but you might unlock enough transactions to get some price discovery. But again, if you're rolling from a 3% mortgage to a 5% mortgage, you're still not going to be willing to just pay higher prices. You're going to be negotiating. So I think when we see the housing market unfreeze, you're going to get supply and demand, and not necessarily that typical response of lower rates equal higher prices, because we're coming from such an unusual constellation of dynamics in the housing market.
Julia, great to get some time with you. Thanks so much for joining us. Julia Coronado there of Macropolicy Perspectives out of Austin, Texas. This is Bloomberg.
It is time now for Social Climbers, the company making waves this morning. First up, Salesforce. They are rethinking their AI business model. The software giant says it will charge $2 per conversation with AI assistants when they handle tasks like customer service. The new pricing strategy aims to protect Salesforce if AI contributes to future job losses, and then clients have fewer workers to buy subscriptions to the company's software. Finally, storied fashion designer Michael Kors says the competition in the handbag space is incredibly robust in the era of TikTok. He told a federal judge that he first learned about one brand only when he saw a photo of the bag on Taylor Swift's arm, who we obviously all get fashion advice from. Kors is in the second week of hearing that will decide the fate of a deal between Tapestry and Capri, which I don't get this one, Matt. The government trying to protect us from aspirational luxury coming together? I don't know.
No, I don't get it either, but I guess that's one of those things that maybe J.D. Vance would support as well. You can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. Danny, thanks very much for that. Coming up, we're going to speak to the CEO of Snap-on. Would it be editorializing to say they make the best tools in the world? We'll ask the CEO next. This is Bloomberg. In today's C-Suite, we are looking at the broader stakes involved in the Fed's mission to avert a recession. Joining us with a boots-on-the-ground view on the economy is Nick Pinchuk. He's the CEO of Snap-on. Snap-on is, of course, a manufacturer of high-end tools and equipment. It's all made right here in America and used in shops across the country and really around the world, as well as in pit lanes. Nick, thanks so much for joining us. Let me ask you, first of all, your take on the economy. I know you visit garages on a regular basis. How's business?
I have to say one thing. You said before that Snap-on makes the best tools in the world. You're right. You know, so that you're right. I agree with that completely. So let's start an agreement. Look, these are interesting times. So how's business? You know, business actually at one level is great. The business across the garages, and we do visit mechanics. We visit almost 1 million mechanics, and we see them every week. So we have our finger on the pulse, and they are what I would say, they have a lot of jobs in mechanic land these days, but they are confidence poor. We would say they continue to be cash rich and confidence poor. Basically, they're affected by, they're getting cash, but they're looking at things like that they read every morning in the paper, like the 2 wars and the border chaos and the idea that, okay, we're having a tit for tat from China, and they see the prices. I mean, the prices are pretty high, you know, when it's not the inflation, it's the absolute prices, as many people have documented. Gas is up 32% over pre-pandemic levels. It's $4 for a gallon of milk now versus $3. They remember the $3. They know it's high. You know, so I think, and the election is making things more uncertain. So they're walking around there. They're almost like characters out of the Game of Thrones in the Stark family saying, winter is coming, winter is coming. So what we see from them is they're willing to buy shorter payback items, things they can pay off in 12 to 15 weeks, but things that, like this box behind me here, that'll take 3-4 years to pay off, they're shying away from them now. I think the retail sales this morning sort of said something like that. Retail sales are up, but car sales are down. And so I think that at the top level, that sort of says something like that. So you're seeing them being uncertain.
So does that mean, Nick, you welcome a rate cut by the Fed? I mean, whether it's 25 or 50 basis points, there can be some argument about what that does to mortgage rates and home sales, but surely it's going to lift car sales.
It probably will, but new car sales doesn't make much difference to us. It's the car park. There's 17 million new cars sold every year. About 4.5% get scrapped, but there are 285 million cars on the road. So that's the thing that makes a difference. New car sales doesn't make much difference in repair. People repair their cars come hell or high water, which is why the garages are still full. If you're talking about the rate cuts, I've been watching the shows in preparation for this, and, boy, we live in different worlds. There's been about a gazillion hours spent on the rate cuts, and for us, we go, it's not going to make any difference. Nobody in the garages, nobody in the factories worried about what Powell is going to do tomorrow. Nobody. Now, the effect may get them longer term, but it's not going to make a short-term difference. People ask me all the time, well, when's this uncertainty going to go away? Well, when I look at the election's only raising the uncertainty, if you think about it. They changed the lineup at the last minute. That's okay, but they changed the lineup at the last minute. And these guys are lobbying megaton-type programs. No tax on tips, no tax on overtime. We're gonna control prices. We're gonna tariff everybody in the world, and the Chinese tariffs are gonna go up to 100%. And these are programs which everybody knows, even at the garage level, that they're going to be tough to execute, difficult to execute, challenging to get through Congress, questionable whether you can pay for them, and uncertain as the effect. Like I said at the the garages see all this, and it creates more uncertainty.
Nick, just to jump in here.
Let me finish. I was just in the garage the other day, and one of the mechanics said, "Welcome to the Mad Hatter's Tea Party."
Nick, I wanted to jump in though because. Okay, lobbying a bunch of different things, right? Small business benefits, tariffs, what have you. Is there anything at all you've heard from the candidates that you've thought, that's a good idea, that would help business, that would help the floors that I go to every day? Or do you look at everything and say, don't buy it?
You're not talking about me, though. I'm not buying tools. You're talking about the guys in the garage. You see what I mean? This is a different group of people. One of the things I think we lose sight of, when you're in the financial economy versus the grassroots economy, is when you're talking about prosperity, people of America trust, people have said this before, people of America trust their feelings more than they trust the data. So if you're talking about companies now, if you want to raise up to the companies, sadly now, companies are now also being more uncertain. Manufacturers are more uncertain because when they look at the total package, they see lack of support for things that would advance, like R&D expensing and expensing capital expenditures and interest, and the idea that, okay, we're going to raise the rates on individual rates, which will affect half manufacturers, which are pass-through companies, and make some of the very soul of our business community, the underpinning of our business community, less viable. And then the idea that people talk about business is against the common good. So what's happened now is we've kind of frittered away or diminished an opportunity. After the pandemic, we were poised to reshore. And I thought that was a great opportunity to bring manufacturing back to America. Because manufacturing isn't a sector, it's a profession that promotes the general welfare and allows individuals to keep their families warm and safe and dry while knowing that they matter to other people. They saw it in the pandemic when they kept us from disintegrating while we engage the COVID.
Well, Nick, it does seem like, look, I went and saw Donald Trump speak at the Economic Club of New York, and he wasn't talking about eating cats and dogs in Springfield, but more focused on, cutting the corporate tax rate to 15% for companies that produce goods in the U.S. Now, you already do that, but it seems like he really wants to encourage companies to bring manufacturing back. And aren't you in support of that sort of thing?
Well, we're in support. I'm not in support of, but I'm not in support of any general particular policy Because as we talked about in the beginning, each of them has a kind of payback and an offset. What we'd like to see, National Association of Manufacturers, the manufacturers I talk to, we'd like to see an administration that recognizes the essential nature of manufacturing. The idea that in the United States, we welcome immigration and welcome diversity. We welcome those things, but what we've celebrated is what we have in common. And one of the great things America's had in common is manufacturing. And therefore, anybody who would look at policy through the lens of making our manufacturing profession stronger is the kind of administration we have. The details aren't really important. You know, there are other people who talk about, say, well, we don't need manufacturing. We should be a society that depends on ideas and transaction. Well, that really doesn't work. It didn't work in the pandemic. It didn't work in World War II. And if you basically, fundamentally, what happens is manufacturing allows, if you manufacture in the country, like we demonstrate at Snap-on, up close and personal to the people that use your product, you don't raise, you maybe raise costs temporarily, but the productivity of the American worker is so strong it brings it down. The people who say manufacturing isn't a good idea in America or isn't important to America are those who have a pessimism about American workers. I say American workers aren't the problem. They are the answer. They're our biggest advantage. If you want an example of this, read the Wall Street Journal yesterday or 2 days ago when the Ford CEO went to China and was daunted by what they did in electric cars. Well, how did they do that? Because they manufactured locally. They manufactured locally, built the skills, created the productivity, observed how those cars were being used, and made them more important and more innovative and more capable to the point the world is trembling over it. We can do the same thing.
Nick, I got to ask you, because you mentioned EVs. You know, I use tools in my garage all the time to work on internal combustion engines. Is there as much demand for Snap-on product if we are living in a world of electric vehicles?
More, I think. Actually, the electric vehicles, yeah, they have fewer parts, but those systems are much more complicated. That's one of the great things about the vehicle repair business. Cars just keep getting more complex, and part of the complexity is the overlay of new powertrains, EVs, plug-in hybrids, which are both internal combustion and electric vehicles, and super hybrids. So they're going to need new cars. EVs need insulating tools. They need special controls that take care of the air conditioning so it doesn't overheat the battery. They need special lifts to lift the battery. And already, in fact, Matt, 80% of the repairs on a car aren't made on a powertrain. So all that ancillary stuff stays. So in fact, EVs, people say they're going to adopt EVs. It's music to our ears because it just complicates the tool sets and expands the range of the tool sets. You know, I was talking about the average senior mechanic has to know how to do 2,000 procedures, 2,000 different procedures. That's more than probably a surgeon has to know. And if you introduce EVs and plug-in hybrids and super hybrids into the mix, they're going to have to do even more than those 2,000. And that will mean more tools.
Nick, I mean, just really quickly, is the labor force ready for that type of skill it takes to do these more ever complicated type things and repairs on a car?
I could cheer when I hear you ask that question because Snap-on provides the tools that enables them to do that. That's number one. That's what we're in the business of doing, enable them to do that, either through electronic diagnostics equipment or databases. We have databases that are 315 billion repair records that enable a guy to analyze the ever-increasing complexity of the cars. But you do raise a point that one of the seminal issues of our day, one of the most important things we can do in America is to expand and upskill the American workforce. Because manufacturing is great, but there are 505,000 National Association of Manufacturers says there are 505,000 manufacturing jobs open today. We can't fill them partially because we don't have the skills. So manufacturing is essential for our future. It's been essential for our past. It will be essential for our future. And we need to upskill the American workforce in a whole group of ways so that they can do these technical jobs. They can do those technical jobs. Because, see, that's our strength. 300 million people, 360 million people. We arm them with these technical skills.
Yeah.
No other country can stand against America.
Nick,
and that's just not
you are one of the best. Unfortunately, we're going to have to leave it there. Thanks so much for joining. Honestly, always so wonderful to hear from you. Nick Pinchuk, the CEO of Snap-on. Now, coming up, Speaking of EVs, the reluctance to adopt EVs isn't universal. The CEO of Ford Pro tells us why commercial customers are ahead of the curve on the EV transition. And just quickly before we go to break, if you're wondering why I'm here and Sonali's at, this will help solve that. You're looking at a conversation with the CFTC chair, Rostin Benham, and Bloomberg Sonali Basak. They're talking at the 2024 Financial Markets Quality Conference at Georgetown University. Live Go is where you want to head to watch that.
Over a decade, goes back to about 2011 or 2012, on how we view these contracts. These are binary options. They're essentially yes or no bets on the outcome of an event. And the event can be related to weather, to
Time for our daily Wall Street Week conversation. U.S. consumers are hesitating to adopt EVs in part because of how expensive they are and difficult to charge. Wall Street Week's David Weston sat down with the Ford Pro CEO, Ted Cannis, to ask why the calculus is so different for commercial fleets.
Actually, that's the whole point of when we created Ford Pro, to really dedicate a segment in the company only on these commercial and government customers, was to give them more than a vehicle. Once it became connected with this data and software and then Internet of Things, both the internal combustion and the battery electric vehicle, once we could provide that, then we could offer vehicles, software, service, charging, and financing, and we connect physical, digital connected vehicles to software services, to physical service and mobile service that we provide. And now they can all connect supply and demand digitally much more efficiently than we used to do. And that is the real essence of it.
As you project out, is there a point at which the services are as much a part of your business as the vehicle itself? I mean, is it as much in revenue or certainly in profitability?
So what we see today is about 13% is services, software, and the service that we provide. We see by 26, that's going to grow to about 20%. So with this connecting and making it easier to match up what the vehicle needs to what the service can do digitally, preparing the parts even before it's come in for service, now we can match up efficiently like we never could do before.
A lot of demand. Are you able to meet the demand that you have?
Demand has been, I guess it's good news, demand has been really strong. In the U.S., we've had incredible large infrastructure projects going on, the overhaul of the grid that's going on, AI demands on electrification, telecom, and everything is being delivered, both services and goods. And this has created a whole new sets of business for us. So we see incredible demand across all our vehicle lines, both here and in Europe.
We'll talk about that in terms of the lines of customer business that you look at. What are the big growth areas in terms of commercial enterprises really needing your vehicles?
Well, we see a bit of everything. Like in the EV space, state and local government is really exploding. Something like 70% of our e-transit sales are through those government opportunities. And we see them investing in the future and trying to create cleaner cities. But in others, like areas like last mile delivery, large companies that never were delivering from their facilities before, not the names we all know about, but are now delivering to homes. Service, we see haircutting going home and pet grooming going home. These are things that didn't happen, and we offer mobile service. So this opportunity to connect customers and moving transport digitally is what the e-commerce age has allowed us to do, and we are benefiting from that.
Do you have a backlog?
We have a backlog.
How bad?
Well, who knows? It's the demand remains so strong. I really can't say, and it's going. But it's for the rest of this year. I see it's going to be a backlog.
Do you have any concern that may give an opportunity to competitors? If they can't get the vehicles they want when they want to get it, they might go someplace else.
That has been a concern, but there's no question that if there's open capacity, people prefer our products. In fact, 25% of the fleets are Ford only, which is 2.5 times more than anybody else. So we've been adding capacity on Super Duty. Last year, we added capacity on our transit in Kansas City, adding a third shift. So we've been lifting our capacity levels, and it's something we're definitely looking at.
On the passenger side, we spend a lot of time talking about foreign competition. I mean, certainly Japan, Korea, now increasingly even China we talk about. Is that true in the commercial part of the business?
It is, but it's to a less extent. So we see, for example, in North America, it's much smaller external competition in the space of these traditional businesses that have a very strong link of service and really are looking for this network and have a large park of vehicles over many years, and they're looking for continuous support. So it's less penetrated. But even in Europe, where we have Chinese entries that have grown, they've grown a lot less in the commercial space. So they're going to come, and we need to be prepared because we need to be competitive.
That was Ted Cannis, the CEO of Ford Pro. David Weston joins us now. And David, I'm fascinated by this story and have been. I think in automotive, it really stands out. Why do commercial fleets, is it that it's energy efficient, they need less maintenance with these EVs, and they can do the work? They're essentially a tool that they're driving around.
What I learned from this is it's very simple, because people can make money off of it. When you're a consumer going out to buy an EV versus an internal combustion engine car, it doesn't make much difference to you except how much money you could save on gasoline. But for a fleet owner that has a lot of vehicles out there, they can really charge them every night when they come back, just like their iPhone. They just put it in the shop and charge it up. And they can monitor, as you heard there from Ted Cannis, monitor exactly the state of all their vehicles, where they are, where they should be going, redirect them to be more efficient, make sure they anticipate maintenance requirements, things like that. So it's very simply, this is how people think they can make more money, is by having EVs.
I also really love that competition question, even though he shrugged it off for now, because you had Jim Farley, the CEO, not that long ago going to China, test driving not a commercial EV, but an EV, and was surprised by how good the technology is. How much does that weigh on them, the amount of innovation and pushing forward they need to do in order to kind of put that competition aside?
Well, certainly since Farley came back from China, I suspect it's weighing on the line, because that was quite a piece, because he basically came back and said, including his board members, we're getting beat by the Chinese. They're ahead of us, because he went over there and saw these really high-tech vehicles really advancing and for very low price points. And they take a look at it. They brought some back and took them apart. You know this well, Matt, but they really are looking at China and saying, boy, they're awfully good at what they're doing.
Yeah, he's really fascinated by it. I'm fascinated by the new Wall Street Week. Really looking forward to see your relaunch on Friday at 6 o'clock.
Well, we're very excited about what we're doing. Exactly. We're going to do a piece, actually, on the business of education and what's gone wrong with higher education, as well as one on restaurants.
All right, looking forward to that. David, thank you so much. That is Wall Street Week host David Weston. And as Matt mentioned, Wall Street Week, the new launch of it, you can catch that Friday at 6 p.m. New York time. And a quick look on your equity market this morning. Off to the races with a retail sales data that did nothing for us. S&P
a new all-time high.
At a % all-time high. By the way, equal weighted measure also at an all-time high. How about that? This is Bloomberg. The race for the White House is being closely watched around the world, including in the Middle East, where tensions remain high. Bloomberg's Jomana Bersetchi spoke with the Iraqi prime minister in an exclusive interview. Take a listen.
Our understanding of the situation of the relationship between Iraq and Iran is based on mutual interests and mutual respect. Iran is a neighboring country, and we share 1,400 kilometers, and it's in our interest to have a close relationship, especially that Iran has been supportive of the political process and our efforts in combating terrorism. Of course, Iraq is the only country in the region that has a special relationship between Iran and the United States, and we try through this positive characteristic to help in bringing opinions closer, and we are interested to have stability in the region, away from the Axis policy. We don't want the tense relationships and the stances of other countries of the world to impact the Iraqi situation. This is our diplomatic effort and movement in terms of our bilateral and regional ties.
That was the Iraqi Prime Minister speaking to Bloomberg's Jomana Bersetchi in an exclusive interview. You can find more of that on the Bloomberg terminal. Now, in terms of markets right now, we have hit another, at least the closing high, 56.67. We bounced back off of that, but we're near as damn it to it. And the NASDAQ is up 0.75% as we approach this Fed meeting tomorrow. You know, I've been watching your show. I've been watching surveillance the last couple of days and really getting into this 25 versus 50 debate. The annoying thing is that it won't be over tomorrow when we come back on this show. We have to wait till tomorrow afternoon.
Yeah, I'm annoyed about that too. I would just like to get it over with. But Matt, the crazy thing, this market's still pricing like 52% odds we get 50 basis points. Stocks are at an all-time high. The Russell's up 1.3%. The equal weighted measure is up at an all-time high. And we're talking about cutting 50 basis points. It's something the Fed that previously has done in 2001 when the stock market was tanking, in 2007 when the credit market was tanking. But everything's wonderful.
Never when we are at all-time highs and financial conditions are incredibly loose. But I guess they think they're restrictive right now. Coming up tomorrow on Open Interest, our Fed Day lineup includes BlackRock's Kate Moore, as well as Bess Friedman, the CEO of Brown Harris Stevens. We'll talk real estate with her. This is Bloomberg.